Tito's Handmade Vodka is America's favorite vodka for a reason. From the first legal distillery in Texas, Tito's is 6 times distilled till it's just right. And naturally gluten-free, making it a high-quality spirit that mixes with just about anything. From the smoothest martinis to the best Bloody Marys. Tito's is known for giving back, teaming up with nonprofits to serve its communities and do good for dogs. Make your next cocktail with Tito's. Distilled and bottled by 5th Generation Inc., Austin, Texas. 40% alcohol by volume. Savor responsibly.
Reality radio for a really great future. We're talking real money.
Well, you have tuned in to the right show if you want to get a better handle on your dough. This is Talking Real Money. I'm Don McDonald. That's Tom Cock. Thank you so much for being where you are right now listening to us. We truly appreciate it. 855-935-TALK is our phone number. That's 855-935-8255. If you have a money question and you're looking for a straight answer, one uncolored by a profit motive, we're not going to sell you anything. We want you to get the right direction and the right help and really build that future for you. Yes, we're in the business of managing money, but we're not trying to pitch you on us. We want you to get it right. So give us a call. 855-935-TALK, 855-935-8255. Now, we talk a lot about Vanguard. We have over the years. We've probably talked about Vanguard more than any other investment, organization in the world.
No, I think that's true. And this goes back 30 plus years, right?
Yeah. I mean, yeah.
98. 88, pardon me, 1988. So that
Vanguard has been a really wonderful, respectable, low-cost,
owned by its shareholders.
Yeah, but lately, Vanguard's getting a little weird. They're pushing the envelope a bit. They're
allowing crypto in.
Yeah, and they're doing some weird things with funds that you'd think don't need a lot of tweaking. Like target date funds. They seem pretty straightforward. Did they need fixing?
No.
Vanguard thinks so.
And by the way, Vanguard runs about 40% of the money in target date funds, which is a huge number.
They have great target date funds.
Yeah. They're very inexpensive. 8 basis points. So $4.5 trillion in target date funds. I mean, who would have thought that even 10 years ago? That is a lot of money.
Yeah.
And for most people, it's easy.
It's the epitome of rebalancing.
Yep. Boom.
I mean,
money
it's
goes
age-based, but it's simple.
Yeah. And they fix the risk in your portfolio as you get older to less.
Right. And the nice thing about them is you can still personalize them a little bit. For example, if you're going to be retiring in 2040, you could get a 2040. Or if you want to be a little more aggressive, you can go out to 2050.
Yeah. And now they're adding another feature.
Oh, I don't like this.
And they show in this piece in the Wall Street Journal, they show a picture of John Bogle.
He would have been
I don't think would love
opposed.
this. Yeah, I don't think he would love this because what are we talking about? Well, Vanguard plans to let workers buy an annuity within a new 401k target date fund. Now, when you buy an annuity in a target date fund, what's the target date? What target date are we aiming at?
That you
the end of your life.
Yes.
No, I was thinking
I see what you're saying. Yeah.
Target date what?
Well, that's kind of what the annuity does.
Yeah,
but it sounds like a complication to me.
Yeah. Well, I think it is a complication. And according to this piece, they allow you to use 25% of your portfolio in that. And they're not the only ones, by the way. Not even close. State Street, JP Morgan, BlackRock, they have introduced target date funds with annuities. Again, they're not alone here. But here's where it gets interesting to me. Because in the article it talks about a 65-year-old worker nearing retirement with $1 million portfolio. There's hopefully a lot of those people that would use 25% to pay for an annuity, which would provide about $1,670 a month. Okay? Mm-hmm. The worker would be able to withdraw the rest of the 401k savings, which would remain in stocks and bonds. Does not have the cost, by the way, what they're going to charge you for that, because I looked, somebody else is charging 1.5, which seems spendy. But $1,670 a month from $250,000 by my calculator is somewhere around 8% withdrawal rate.
Which makes
pretty
sense.
Aggressive.
No. It really isn't, because a big chunk of that is your principal coming back to you.
Yeah. Well, it depends on how long you got, too, right?
Yeah. Now, they're working with TIAA.
Yeah. They're the ones actually going to have the annuity product, and they've done a lot of work for nonprofits, universities, et cetera. You know, TIAA.
Yeah. I don't know, though. What I don't understand is this a solution in search of a problem to solve?
No, I think there's many people can be great savers, and they have a lot of trouble figuring out how to get the money out of their portfolio properly with the least amount of tax.
Yeah, but can't they just go buy an annuity?
But it might be a lot more expensive than what Vanguard's going to offer.
Maybe,
right.
But we don't know.
Yeah. No, we don't know.
We don't know.
That's fair. If you just went out and go to, I don't know, who would you go to for a no-load? That's the challenge. I mean, no-load, I guess, immediate annuity.
There are no-load immediate annuities.
But would the payout be this high? I don't think it'd be this high.
Probably. That may be part of the reason why the payoff is this high, because there's less money going to TIAA than would normally go to an insurance company in the actuarial calculation. The age and return calculation that they have to do. Remember, the insurance company is guessing. They're doing math, but they're not sure how long you're going to live and how well the investments will do.
And let's look at their track record. They did horribly with long-term care, right? I mean, 25 years ago, they thought this was the new gold mine. They took it in the seat on that one. I mean, it's been horrible. That's why they all pulled back.
And that's the other thing about the whole annuity business. It's part of the insurance industry, and insurance is not as safe as the insurance people want you to believe it is. It's just not. So I don't know if I'm in favor of this or not. I'm going to have to learn a lot more about the underlying structure. This was brand new news. It just came out. But I'd like to know more about them. 855-935-TALK is our number.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
I was going to go right to the phones, but then I read the fine print on the Vanguard income
I couldn't find much on it because it's been out just for a few days.
Yeah, clear down at the bottom. It says these are collective trusts, not mutual funds.
I did see that. Yeah, I did see that. CIT. There's a lot. Jason Zweig wrote about this yesterday for those of you who want to pay better attention.
Collective trusts are very lightly regulated.
They are.
And aren't
there's a lot more to get away
to
with.
Disclose. Vanguard.
I know. It's an interesting turn there at the end.
They created a new company, Vanguard did, called the Vanguard Fiduciary Trust Company.
Yeah.
Which means it's more like a bank trust department than a mutual. Interesting. We're gonna look into this a lot more. There'll be more conversation about this coming up in future programs. But we do have phone calls that have come in to 855-935-TALK. And the first one is from my favorite state in the union. I wish I lived there,
Colorado.
but my wife won't let me. Colorado. Rob, welcome to Talking Real Money. Go Broncos.
Rocky Mountain High.
Thank you, guys. Thanks for taking the call. I hope that this is, I can verbally express what I'm trying to do here. Well, this is Roth conversion. We have about 1.7 in traditional IRAs. I've been doing small conversions in the past couple of years in the neighborhood of, $50,000, $70,000 type of ranges. Mm-hmm. When I do that conversion, I have a small brokerage account that's only $100,000. I'm using that money to pay for the tax for the Roth conversion.
Mm-hmm.
However, this past year, I'm 69, haven't worked in a year or two. This past year, I've been taking money out of the IRA to fund and augment our Social Security. So I kind of feel like I'm robbing Peter to pay Paul by pulling traditional IRA money out and using the brokerage instead of using the brokerage money to live on.
Yeah.
I'm using that to pay taxes.
Yeah, you might want to stop the conversions.
I wouldn't convert if I was pulling money out to pay the bills.
Yep.
And by the way, it sounds like you're cycling on Pikes Peak or something, but which is great. I mean, good for the exercise.
It's a little cold this time of year up there.
Okay, I kind of wondered. No, I think that would be, unless you took it up to whatever bracket you're in, you could fill that bracket up with a conversion, and you had the tax money to pay. But if you didn't have the money to pay your bills and you had to take it from the IRA anyway, what sense does that make?
Exactly, because then you're paying the taxes out of your IRA, essentially.
Exactly.
Which is
we prefer you not.
Eliminating the benefit.
Yeah.
So if I don't have enough money in the brokerage account, or if I totally deplete the brokerage account and only have a traditional IRA and Social Security, there's no need to do a conversion?
I don't think there's any need in your case to do a conversion. It's just not worth it. The value has gone down to so little, it's not worth the bother. Because you're paying that tax, the tax out of the IRA, essentially.
Yeah. There's no reason. I think you used the term robbing Peter to pay Paul. I completely agree with that.
Okay. All right. Well, I thought I was being foolish, but I'm glad that you confirmed it for me. So
I just stopped.
I appreciate your advice today.
Thanks, Rob. Take care.
Okay.
Thanks. Take care.
Thanks for calling us. Yeah.
Bye.
That's conversions. Everyone thinks no problem to do them.
It's magic. It's like
they just do. Everybody click the button.
No-brainer.
They're harder than that. And part two is Rob. It makes the exact correct point. You got to have the cash to pay the taxes. Mm-hmm. If you're paying that out of the IRA,
then you've just eliminated the benefit of the conversion.
Yeah, it's and on top of that, in his case, you're using it to pay the bills. Then it's no way. So your thinking is right, Rob.
Yeah. Yeah, the Broncos play the Raiders tomorrow, don't they?
I'm very busy. I have a family thing tomorrow, so I can't get to the game. Otherwise, I'd be all about that, as you know.
Sure you would.
With a bag over my head. Yeah.
All right, let's see. What do we got? Yeah, we got time. Let's. Do we have? Yeah, we do. Let's go to Seattle. Charles, welcome to the show.
Hi, Tom and Don. I sure appreciate all your help and your information over the years. Been listening a long time.
Thank you, sir.
And I've got a question about a couple of funds with Schwab. First of all, I'm glad you're talking about Target Fund because that was one of my questions. What do you think of the SWDRX 2030 Target Fund for Schwab?
And is this, by the way, in an IRA or is this in a brokerage account?
Let's do it in my Roth.
Okay, in your Roth. Okay. Because there's been some problems having these in brokerage accounts, as you may recall from a few years back.
The problem I have with Schwab's target date funds is generally their expense ratio.
And there's no reason to own those when you can own basically the same thing at Vanguard for a whole lot less.
Yeah, the Schwab is like 40 basis points, which is just a lot, in my opinion, too high. The other thing is that Schwab is really chintzy when it comes to international equity in their portfolio.
What's their ratio?
18. Well, let's see. It's they're 40% U.S., 18% international, and 40% fixed income. So that's 2
to 1 is a bit high.
2 to 1 is a bit high. I just think that's pretty chintzy.
Yeah. But for no other reason, I would simply go that's very much a commodity because you're getting a portfolio designed for your, risk tolerance, right? Your risk need. And you can go to Vanguard to get it for, I think it's 8 basis points, or you can stick with Schwab and pay almost 4 times as much. Yeah. Yeah.
Or if you want an ETF, the iShares has target date ETFs that are, let's see, how cheap is that? 10 basis points instead of 40. So 1/10
1/4 of the price.
Yeah. So I just think Schwab charges too much. We like Schwab, but we just don't suggest their funds a lot because they tend to be expensive. 855-935-TALK is our phone number. Charles, thanks for being here. If you want to join us, it's easy. Lines are open right now, and we have a lot of time.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
You know, here's another reason in terms of the target date funds, in addition to the cost. I'm betting Schwab's has an active manage. I mean, because of the 40 basis point charge, I don't know, is that an index fund or not? But part two is, you've heard recently that a lot of these target date funds are going to start adding more gimmicky kind of things, private credit, private equity, those things. My take is, in a general sense, Vanguard is less likely to add those now where a Schwab might. No offense to Schwab again, but their funds, they're just, the management just not as careful.
As a matter of fact, you're dead on. Here's the portfolio in the Schwab target date. They have some of Schwab's index funds.
Yep.
But they also have Dodge and Cox.
Yep.
PIMCO.
Yeah.
Allspring.
These are all actively managed funds.
Yeah.
So
Schwab Select Large Cap Growth. So they have some actively managed funds which kick their fee up, and so we don't want you to have actively managed. We don't want. We don't think you need.
Well, there's no track record. In fact, there's quite the opposite of active management doing better than just owning the market. Period.
Well, and in the case of the Schwab portfolio, it's actually they have actually beaten the index and their category, but they do it at a slightly higher risk level.
Yeah.
So that's always the trade-off. That really is always the trade-off.
I know. No one wants to believe
their risk is almost commensurately high, as high as their increased return over the indexes. So it's a trade-off.
Yeah.
855-935-TALK. Call us. We'd love to talk with you. And let's go to Missouri. Randy, welcome to our program.
Hi, Don and Tom.
Hey,
Thanks for taking my call. It's kind of a funny situation I got myself in. I am not a market timer by any means, but I was in a mutual fund that just didn't have a lot of it was just limited to 30 or 40 stocks in every fund, and I just wanted to get into something a lot more diversified.
Mm-hmm.
And so I was moving my money from there, to Fidelity. Well, I started in October 28th, and it took me until this Wednesday to finally get my money that I keep in the market moved from point A to point B. The check got lost in the mail. We had to get the supervisor's approval, yada, 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 yada. Anyway, I was kind of in nowhere land, but now my money is there. And just, I know you guys aren't real big on the S&P, but just as a ruler, the market was at 46,100 when the process started, and now it's at, 48 and some change. So it's gone up like 2,000 points in the time I was totally out of the market, and I was just looking for the best way to enter in. If you think
how old are you, Randy? Randy, how old? How old are you?
I've had a big year, 70. Just turned 70.
Oh, 70. Okay. And what is your stock to bond ratio? You sound like somebody who pays attention to this stuff.
Yeah, I actually don't holler at me, but that's fine. I have no bonds. I have a. You want me to run through it real quick?
Sure.
I got $350,000. This is the money I keep in the market. I bought an annuity, which I'm happy with. It pays me $2,200 a month, and I've got like almost $200,000 just in cash set up in CD ladder.
So that's your fixed income portfolio. That's $200,000. That's bond like. Yeah.
Sure.
That's the way I view it.
That's fine.
Neither here nor there. I just never could get a good feel for bonds, so I just didn't go there.
I have a CD ladder.
But it sounds to me like the question is, you're like, when should I get back in? And the answer is, you already know. Yeah, you already know the answer because, A, no one knows what the future is. B, if you have a stock to bond ratio and this is your stock part, you're just going to put it right back in. It's not going to matter.
However, let me add a little.
It doesn't really matter.
Let me add a little complication to it. If you're feeling uncomfortable with the market, then your stock to bond ratio may be too high.
Oh, that's smart.
On the equity side.
Yeah.
If you're feeling skittish,
Okay.
So you should take the risk quiz again.
Yeah, you should go back and take the risk quiz at talkingrealmoney.com because you may want to go like 300,000 in equities and make your CD ladder 250.
Yeah. And as a holiday special, we have the electrode home version of the.
It looks
the
like
risk quiz.
Operation. It looks a lot like
we
the
send
Operation
that in.
game.
Yeah, it's kind of fun. We watch on video while you're taking it. It's good for us.
But the time to put your stocks back in is now. I know it's up, and there were a lot of hassles and headaches. But if you were in, you would have stayed in anyway. So stay in. 855-935-TALK.
Tom and Don are talking real money.
This episode is brought to you by Marqeta. When it comes to your payments provider, you can't afford to compromise. Marqeta's modern payment solutions flex with your business without the trade-offs. Stable and agile, secure and innovative, scalable and configurable. If they say you can't have it all, don't believe them. Your business demands more. Choose a payments provider that delivers more. Choose Marqeta. Visit marqeta.com/Spotify to learn more.
Reality radio for a really great future. We're talking real money.
During the breaks, I kind of play around with some of the things we've been talking about. Like I decided to do a comparison between the Schwab Target 2030 Fund and the Vanguard Target Retirement 2030.
Which is going to be 50% in stocks, 50% in bonds, something like that, or maybe a little more aggressive.
60-40.
60-40, okay.
Yeah. So but what I compared was we know the expense ratio. It's 0.08 for Vanguard, 0.4 for Schwab.
Correct.
So Schwab has actively managed components.
They do.
And they do it because they believe that's going to give you a higher return.
Exactly.
Over 15 years, the Vanguard fund has returned 0.2% more per year over 15 years than has the Schwab fund. Now, that could be totally
15
attributable
years.
Over 15 years.
15 years.
That could be totally attributable to the lower fee, but
could be. Yeah.
But then you find out that Vanguard's standard deviation is 10.6. And
that's a measure of volatility, by the way.
Schwab's is 10.9.
So it's higher.
Higher risk, lower return for Schwab.
Yeah.
Higher return, lower risk for Vanguard.
Yeah, and those would be reasons. Yeah, those are good reasons. Again, into the future, I would just trust Vanguard more to make better decisions about what's in that fund.
Me too.
My take.
Plus, it's going to be the market, and our belief is that the closer you can stay to the market, and not try to beat it by large margins, which is what active managers do, the better off you're likely to be. History has shown us that.
Yeah.
Could it be wrong in the future? Yeah, of course.
Sure.
855-935-TALK is our phone number. Let's go to, it's Jason in Sammamish. Hi, Jason.
Jason.
Good afternoon, guys. How are you?
We're well. Thank you.
Great. So I just wanted to give an end-of-year public service announcement for your listeners. So, I know we've had a lot of news about job losses, and this may be a low-income year for a lot of people.
Yeah.
Lower than in the past. So, obviously, I know you guys are against single stocks and realizing capital gains on those, but you can also do this to ETFs. So if some of your listeners have a low-income year, it would be prime, and they want to stay in a particular ETF or stock, it would be great to realize any long-term capital gains to potentially pay no taxes or very low taxes, depending on how much they earn this year.
You're talking about tax planning.
Capital gains. Yeah, tax planning. That makes sense.
Right.
Yeah. You have up to $70,000, or if your income has to be 70 or more to pay anything, I think, on capital gains, if I remember right.
I think for a single person, it's like 40 or something.
Okay, I was speaking,
public service.
Married. We're old married people, so we always speak in joint.
Always married. Yeah, that's right. So
Understood. Yeah, but just a heads up for people who may not be aware of this, because I wasn't aware of it until a few months back when I kind of became aware of it. So maybe you want to talk a little more about that or what have you. But
thank you for your public service announcement, which we greatly appreciate. By the way, speaking of ETFs,
my pleasure.
Speaking of ETF, I just read this number. 50. There's been 908 new ETFs launched this year, which is a lot.
Is that 1,000. A lot? I mean, in the grand scheme,
sounds like 1,000. I mean, maybe not, but 50% of them use derivatives, and 30% of them use leverage.
Of the new ones.
Yeah,
because they're running.
These are not products you need, by the way.
That's because they're
for the
running.
Most part.
They're running out of reasons to bring out new ETFs.
Exactly.
I mean,
they just turned down, I think, a 3X fund for somebody. The SEC did.
All of the indexes are covered, so now they're going to stretch. Let's see. I'm trying to figure out how many.
Jason, thank you, by the way, for your loyalty, listening, and calling. We do appreciate it. I know we give you kind of a bad time.
Well, because of Tesla.
It's only I know. Tesla. He's a good sport about the whole thing. I think he could be waiting right outside my door here. I don't know. So
yeah.
Well, it's the holidays giving season, right?
Hopefully you're not getting killed anytime soon.
No, a swift kick, I said. I didn't say
we have, looks like there are about 12,000 ETFs.
Yeah. Well, so 1,000 is a substantial number.
I guess that is a substantial amount.
And that's where all the money's going, right? It's going out of funds into exchange traded funds.
As
Huge.
It should.
They're
it should.
Actually, but again, as long as it's into the right ones.
Yeah.
Yeah. You can buy bad mutual funds and bad ETFs.
I was going to say, that's the same thing with mutual funds.
But people think because it's an exchange traded fund, it's going to be better. Like, no, you could buy really bad ETFs.
A bad exchange traded fund is just as bad as a bad mutual fund.
Thank you. That's the point. So.
They're basically the same kind of vehicle with just some legal differentiation for purposes of disclosure and taxation. But an ETF is an exchange-traded fund. A mutual fund is a mutual fund. They both have the word fund in the name. Exactly. And we just happen to like ETFs because of their structure and because of their low fees. It's generally speaking, if you have the same product, the ETF form of that product is going to cost less than the other because the other has so many disclosure and reporting requirements that exist that their costs go up. They have to send out prospectuses. ETFs don't have to do all that.
And the structure of them allows for a better tax consideration for people, too. So there's that.
Yeah, they were one of the great inventions. I mean, really, they were I think in terms of investing for individuals, they were the greatest invention since the mutual fund. Which
I'll say soccer
in the 20s.
Soccer is the greatest invention ever by man.
So do you think the NFL should change its name from National Football League to National?
Should just go out of business. Just shut down immediately.
National Passing League or
close it down. We've got the World Cup coming next year. Just take a year off or something.
It's only because you're mad at your team. Stop it.
Oh God, I'm not mad.
If the Raiders,
I left disappointment a long time ago.
If the Raiders were winning, your song would be different.
No, I think it'd be exactly the same. I'm still a soccer guy all the way through.
Fan, and I'm still not getting it. You know, like I don't get crypto.
But you're farther along than you were 10 years ago.
Think how far you've come. I still sit there and watch a game and go, well, why aren't they scoring? What takes so long?
Tom and Don are talking real money.
Meet the computer you can talk to. With Copilot on Windows, working, creating, and collaborating is as easy as talking. Got writer's block? Share your screen with Copilot Vision to help spark inspiration, and use Copilot Voice to have a conversation and brainstorm ideas. Or maybe you need some tech help. With Copilot Vision, Copilot sees what you see. Let Copilot talk you through step-by-step guidance so you can master new apps, games, and skills faster. Try now at windows.com/Copilot.
Your guides to a really great financial future. Tom and Don are talking real money.
Our phone number is 855-935-TALK, 855-935-8255. And since we don't have any callers on the line right now, and Tom said we can't do any more of his written ones.
I'll tell Christmas jokes the rest of the time if you want.
Oh, no.
I knew that would change
No, stop. Go read a question.
So you want, okay,
read
you want one of these?
Because the theme
today is Colorado, because it's the holidays, and that's where your heart is at the holidays, right?
Yeah, up in the mountains with the snow.
Up in the mountains. Ooh, that beautiful home in Colorado Springs I remember visiting. And that's where this question comes from.
Colorado Springs.
That's right. Oh. Kathleen, longtime listener.
First-time caller. Oh, wait, not even a caller.
She says, thanks so much for all your wisdom and advice over the year.
Ooh.
I hope she meant over the years, but maybe just over the years. But here's the question. And this comes up a lot. I think we took it recently. It comes up, I don't know, 3-4 times a year. What are your thoughts on a tips fund? Well, if I'm working the front desk, I like a tips fund because people put a lot of money in there. So I'm about that. Such as FIPDX. I find it investing in tips is confusing, and this fund looks like it could help fill the void in a portfolio. Thank you for your wisdom and advice over the year. So question here. A tips Treasury inflation protected securities. Mm-hmm. These are bonds issued by the U.S. government that basically readjust for inflation every 6 months. I mean, it's a little more technical than that, but that's basically what they do. And the idea here is that when inflation is unanticipated, it gives you a little bit of a boost, right? It protects you from rising prices. That's what it's supposed to do.
That's what it's supposed to do.
Yeah, we use them in our managed portfolios for many years. And then, I don't remember where it all, people smarter than me who spend a lot more time on all this, that do a lot more research, looked at it all and said, you know, if you diversify your bond portfolio, hold a little bit international, you're properly invested in the stocks, you kind of protect yourself from inflation as best you can.
Right.
That's kind of what they said.
Basically, the research has said that you get as good a protection from inflation in a well-balanced portfolio that has bonds and equities. Yeah. You're not gaining a lot from tips. And what you lose is decent income in low inflationary times.
That's the problem, right?
So it's a trade-off. So despite the fact that this is a cheap fund, I mean, it's $5.
And it's an index tips because you could buy a Vanguard index.
It's a tip bond index fund.
And I think Vanguard has shorter term and longer term tips funds.
This one has a slightly longer than intermediate maturity.
Okay.
But it's all Treasury and inflation protected securities. Its performance has been pretty similar to bond funds. I mean, is it worth it? Has it been worth it? No.
Okay, and let's go back a couple of years.
I guess if we got ridiculous inflation like we had in the 70s and 80s,
yeah. But how? For example, let's just be curious to know in a year like 2022, which is a very strange year, both stocks and bonds lost money that year. And inflation was unexpected.
No, tips lost money. This tips fund was down over 12%.
Okay, so basically what a bond portfolio was down the same way. I mean, you had rates that were moving fast. So, people, we have this discussion, this argument. And again, at some level, and this came up also recently. People may know this. You and I used to build the portfolios.
We did. We built them ourselves.
We read all the stuff. We sat down and did all that stuff. And now, frankly, we rely on people that spend a lot more time on it and have more education, if you will, about all this.
Yeah. And here's the thing. Tips have turned out, in reality, to be more of a bet on expected inflation than actual protection against inflation. If inflation comes in above expectations, then tips do well. But if inflation lands about where everybody expected, they match treasuries. And if inflation comes in below expectations, treasuries win. So it's almost too much of a gambling type of a security.
Yeah. But going back to bonds management, I mean, you talk about CD ladder, nothing wrong with that. If you build your bond portfolio with, short and intermediate term and high quality, not seeking out yield, you're probably getting almost everything you're going to get from tips anyway. Not entirely. And by the way, yes, diversifying a bit in international gives you some other, but it's got to be hedged, obviously. But there's some things there that could help a bit. And people have a tendency to look at their bond portfolio all wrong. Generally, it's like, why am I not making money there?
I hate bonds. Why am I not making money there? Question.
Yeah,
the guy goes, I hate bonds. I'm not having bonds in my portfolio because they're bad.
Does have he has a
bond
ladder. That it's fixed income, whether you want to call it that or not. So yeah, Stocks, better inflation hedge. I wouldn't run out and buy tips right away for your portfolio.
All right. Thanks for that question, and thanks for all the questions you send in at talkingrealmoney.com on the contact form. We appreciate them. You can speak them or you can type them. Just go to talkingrealmoney.com.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan, one that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at talkingrealmoney.com or call 800-386-3004. That's talkingrealmoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
For your real life and real future, Tom and Don are talking real money.
And it looks like we're going to wrap up the hour on the phones. Let's go to Seattle. And Sam, welcome to Talking Real Money.
Hey, Sam, how can we help?
Hi there. Thank you very much for taking my call. Hey, I listen to many shows, but you guys are my Bible. But hey, my big question, what is a buffered ETF? It sure sounded like an annuity to me.
I thought it was a pill you took before you went out on Saturday night.
That's just a buffer-in.
Oh, buffer-in. A buffered, it's not a product you want or need, I can tell you that, but I don't know if I have an apt description. The idea here is it gives you protection against the downside with stocks.
Yeah,
that's
what
the
they're
idea.
doing is they're putting structured notes in an ETF. They're selling options. They're playing games. And let me just find one that I can look up.
We've talked about this product on past podcasts. I know that because it comes up from time to time. It's been very popular.
The fees tend to be really high. For example, there's one called Simplify Barrier Income ETF, which is a buffered ETF. Its expense ratio is 75 basis points. It is a complicated portfolio. It's like they do treasuries and then they do options, and it's a mess.
It's something that sounds great in.
But I was just trying to be knowledgeable here.
Yeah, it sounds great in practice, but the reality has not matched up with that.
Actually,
and the whole idea
sound
here,
great in practice. It sounds complicated to me.
Well, except that you could put your money all in one place and you don't have to worry about the ups and downs of the market. Hasn't worked out that way, and it's an expensive way. Instead of just having the trade-off between stocks and bonds, for example, which I think you'll be more satisfied with and you'll pay less to others for. I'll put it that way.
It's a gimmick.
Yeah, so that's what I was curious. Thank you very much. You guys are great.
You're very, very welcome. We appreciate it. It's a gimmick. The Wall Street feels like they have to make magical products to convince you to buy their overpriced stuff. They have to, and the magic is always high returns, low risk.
Exactly.
Because that's what you tell them you want. But you can't have it. You can have low risk or you can have high returns.
Yep. There's a trade-off. And you're correct. Buffered ETFs, extremely popular product in the last couple of years, especially, I think somebody called it cotton candy for boomers or something, because it's tastes good, but it melts away in your mouth or something.
Let's see.
Not that helpful. So.
Yeah, I'm just looking. They're all. I'm pulling up some others. They're all in that really high, over 0.5% plus expense ratio, which that alone detracts. It just kills you. So thanks for the question, and thank you all for being a part of the program.
Indeed.
And please, if you've got questions, go to talkingrealmoney.com and send them in to us on the contact form. You can speak them. They go on the Friday podcast. You can type them. They go on one of the other podcasts or the radio show. And we have one other really cool thing we have been doing for people for 15 years.
Yeah, well, on our own. We did it before at Merriman. People did it there, too.
Yeah, but we've been doing it on our own through our firm for 15 years, and that is we will help anybody. We don't believe that just because you don't have enough assets or just because you don't are you you're a do-it-yourselfer? You don't want help? That you shouldn't be able to get somebody to look at what you're doing and say, here's another opinion. Whether you take it or not, whether you use this down the road or not, it doesn't matter. You just go to talkingrealmoney.com and click on that button on the website that says meet an advisor, and it's free. There's no obligation, no high-pressure sales pitch.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.